In this episode of The Blueprint, we will cover finance. Finance is an important component to restoring a neighborhood. Finance allows residents in the community to establish capital gain like owning property and starting businesses. Without finance, it is impossible to invest in the community. It is also noteworthy that finance without the employment initiative will not succeed. To be eligible for any finance, you have to have gainful employment. Let's break this down. One of the most debilitating factors that remain in play to contribute to these problems is the fact that most people in these neighborhoods do not own their home. People in lower income neighborhoods tend to rent their homes or apartments. What this means is that most of the working income that could be staying in these neighborhoods is leaving the neighborhood. The money spent on rent in low income areas does not stay in that area, it leaves and goes to the neighborhood of the landlord or landowner. When landlords own most of the property in a general area, it's a good indication that it's a low-income area. Another factor is circulation of the dollar for that neighborhood. For a general economy to do well, the money needs to circulate over and over and over again in the same community. Minority communities tend to have a much lower rate of recirculation for their dollars than their white counterparts. Factors that dictate recirculation are, number 1, having more homeowners than landlords in the neighborhood, number 2, people who live in the community owning small businesses in the neighborhood instead of people who don't live in the community. Number 3, residents in the community supporting those community-based small businesses. Number 4, those community-based businesses need to hire residents in the community. An example of how money circulates in the community is a resident that lives in the community also works in the community. The job he or she works at is owned by someone in the community. The business generates opportunities for the community. That person gets paid from their community-based job, and then goes to spend money in the same community at a grocery store that is owned by someone else who lives in the community. That grocery store subsequently employs a number of people in the same community. When those individuals get paid from their job and spend their money at various other vendors that are potentially owned by people in the community, therefore money generated in the community has the potential to continue circulating in the community continuously. This is how money is supposed to work. Finance can be established in the community by patronizing community-owned banks. Before purchasing houses, cars, or taking out business loans, individuals should take the time to educate themselves on what a good finance rate is, which is generally 6 to 7% on a fixed-rate mortgage. After that, the home buyer should take the time to find a community-owned bank to give their business to. Oftentimes, smaller community-owned banks will give you better interest rates than major bank brands who are notorious for abusing home buyers through bad business practices. A social media movement to drive homebuyers and loan seekers towards community-owned banks would be helpful to help the small banks who cannot afford to compete with the marketing cost of the larger banks. Using social media platforms to inform residents where their community-owned banks are by creating a database broken down by state and city, and then using that to drive traffic to the community-owned banks and away from the big banks. Remember to patronize community-owned businesses first. Having a strategy to invigorate your community's economy will give you clear and achievable objectives. Like and subscribe to this channel to get notifications when we drop new videos.